More on the SVB fallout this morning. Want to bring in former SEC Chairman Jay Clayton. He's now a non-executive chair of Apollo, American Express board member, senior policy advisor, Sullivan Cromwell, and a CNBC contributor. But for the purposes of this conversation, an actor, if you will, during 2008's financial crisis, involved in so many of the transactions that happened during that weekend. So let's start there, Jay. Are the comparisons apt? And do you look at this and say it's over, it's finished, or there's more to come?
Look, I think, like always, there are valid comparisons and there are differences. I think the difference that we should talk about is that in 2008, we were talking about individual institutions as systemically important. I think what we're talking about here is the regional banking system writ large as systemically important. And what happened was you had what I would say is an isolated incident at a fairly idiosyncratic bank bring to the fore an issue, which was, what do we do about excess deposits,
right?
Deposits above $250,000 in the event of a failure. And that caused people to question whether their excess deposits at very solvent institutions were something that they should adjust, causing a classic run.
Right.
So it's really the regional banking system at large, and I absolutely believe that the federal regulators were right to step in and say, we need to bring a halt to that.
But, Jay, is it going to work? Is it going to work? Is everybody out there who's got their money at a smaller regional bank this morning saying to themselves, okay, I can keep going on my day as normal? Or are they continuing to keep some of the phone numbers at JP Morgan are busy because you can't get somebody on the line to open an account?
We've talked about this before, Andrew, and whether it's the government making a statement in a time of stress or a company making a statement in the time of stress, that statement is always tested by the marketplace. And that's why I applaud the statements that came out, because they are, in effect, whatever it takes statements in terms of taking care of depositors. Depositors, these are individuals, small businesses. Of course, there are some large businesses who are more sophisticated, but by and large, these are people who just want to know that their money in the bank is money good.
Jay, though, let me ask you this. You were a Republican member of the Trump administration. I assume you are against, broadly speaking, big government. This is big government. In fact, I could argue to you that today all of the banking business has just been de facto nationalized if, in fact, we are going to be guaranteeing deposits across the board. What do you think of that?
Look, Andrew, big government, small government, government is an immense part of all of our lives. Okay, so it really is about smart government. I mean, what is government? 18, 20% of the economy. Our financial system is one of the most highly regulated businesses, industries in the world. Government is in the financial business every day. Now, on the post, look, what was done this weekend was what needed to be done in the moment. And when you're acting in the moment, you need to act broadly and powerfully. Is there a time, as both Rogers that you've had on said so well, is there a time now where we have to recalibrate? Do we raise the FDIC insurance limit, but not make it unlimited? Things like that, definitely ask questions. But it's really about government calibration. Right. And look, post-2008, let me make this point. Post-2008, we were really worried about asset quality, stress tests around asset quality. Let's all recognize that duration risk was something that was on the back burner until we had this rapid rise in rates. And now we're all going to deal with it. And again, what the Fed has done here with the guarantee facility is given the market an opportunity. I think that's their aim, to deal with this duration risk.